In this video, we'll apply the concept of maximum and minimum prices to better understand their actual impact in markets. We will look at how the government uses each of these policies to stabilize prices and the potential outcomes of such policies. In AS economics, we learned that an effective price minimum would set a legal limit on the minimum price that could be charged for a good or service, and this price would be above the market equilibrium price. We commonly use the example of a minimum wage to explain this concept. Let's take a look at how that would affect a market. Suppose the government wanted to impose a minimum wage above the equilibrium wage rate of P star. At the equilibrium wage rate, there is an equilibrium quantity of Q star. By raising the wage rate to the minimum wage of P min, it creates an increase in the quantity supplied of labor as workers are more willing to work. Yet, there is a decrease in the quantity demanded of workers as labor has become more expensive to firms. This results in an excess supply of workers at the minimum wage rate, and we would call that excess supply unemployment. With respect to the original level of employment, we can say that employment has fallen by the difference between Q star and QD. In economic theory, this is the argument presented about the impact of a minimum wage, but how does an increase actually fare in reality? Well, in Seattle, Washington, this experiment has been done. The minimum wage has risen to about $15 citywide. These two headlines are a couple of many that cover this topic. I'll include the news links below if you'd like to read more. Our previous economic analysis would have indicated that there would be significant unemployment as a result of this increase, but that actually did not take place. The reasons why are quite nuanced, and a read-through of these two articles will give you greater insight into why analyzing the impact of a minimum wage increase is not as simple as looking at a diagram. Next, we move on to maximum prices. You'll recall from your AS study that an effective maximum price would set a legal limit on the maximum price that could be charged for a good or service, and this price would be below the market equilibrium price. The most commonly cited example is rent control in housing markets. If the government wants to set a rent control in the housing market below the equilibrium price of P star, then it will impact the amount of housing available. The price P max set below the equilibrium price will result in a quantity supplied of QS and a quantity demanded of QD. At P max, the quantity demanded exceeds the quantity supplied, and thus there is a shortage of housing. This occurs because it is less profitable for landlords to rent their housing, and the lower price it makes it more attractive for renters. What's the impact of this in reality? Let's take a look at Sweden. In Stockholm, Sweden, rent controls have resulted in 20-year waiting lists for housing in the city. While the policy is well-intentioned, the result is problematic. With such long wait lists, the question has to be asked about how successful this policy has been. Perhaps a more successful approach would be for the government to finance or subsidize the building of additional housing. By increasing the supply of housing, they should be able to reduce rents and achieve an equilibrium price much closer to their initial plan for their rent limits. By now, you should have a better understanding of how governments can intervene with price stabilization policies to influence markets. The purpose of this video was for you to understand these concepts in context. If you have any questions or comments, leave them below. That's us done for now, and I will see you in the next one.